Hey guys, welcome back to the channel. In this video, I'm going to show you how I maximized my margin for my portfolio in order to create a stream of $60,000 in annual income from high yield ETFs. But before I do, please smash that like button for this banger of a video so the algorithm gods know that I'm here, and hit subscribe if you're new so that you know whenever I go live where I talk about finance news, stocks, and investing, or I publish a new video like the one you're watching. All right guys, with that out of the way, let's get into the video. So if you have not watched this video, how I invest into high yield ETFs, a step-by-step framework for 2025, I really recommend you go out and check that video out, because this video is a continuation of that. That is the foundation. That is basically future-proofing yourself for this eventual integration of margin. Whether you use it or not is entirely up to you. I'm not advocating you should use margin, but if you decide to, setting up your portfolio in a way that protects you is going to be one of the biggest, best choices you ever make. So anyways, with that out of the way, guys, I got to hit you with a disclaimer because we're talking about debt, and I don't want you guys basically to ruin yourselves, ruin your lives, and ruin your portfolio. So just so you know, I'm not a CFA, a CFP, a tax professional, or even a CPA. All right, those are people you should absolutely talk to. I'm just some random dude on YouTube sharing what I've learned and what I'm personally doing. Please do your own research. Don't just copy me. I would hate, again, for you to lose money because you listen to me. All right, so please do your own research and understand exactly what I'm talking about. Debt and margin is a loaded gun. Handle responsibly and with care. Okay. Again, please do your own research. All right. So this is my portfolio, guys. I hold PLTW, NVW, CHIPPY, XPAY, and XDTE. And as you guys can see, I am using an excessive amount of margin, a whole lot of margin. I'm using $98,000 in margin. Okay. My cash into this portfolio is about $95,000. So I have a total account value of like $201,000. But my margin status, this right here, is probably the most important thing when you use margin. You need to make sure you are low risk. Okay. You need to make sure this is always green as much as possible. And you need to have a margin buffer as much as possible. All right, I have $38,000, so I would have to see an account drawdown of about $38,000 before I have to add money to the account, or they will basically sell shares and I get margin called, right? So again, that is the risk. So I would have to see the portfolio drop quite a bit, and it is possible. So this is why you always have to be careful. Now, what determines this, and again, I explained this in the other video, but I want to make sure that I have a good, strong anchor. So I went with XPAY and XDTE. And the reason is because these are S&P 500 cover call ETFs. Not only that, they have a very low maintenance ratio. Okay, very, very low, 25%. Even through Liberation Day and the most brutal, volatile time in the stock market, I never saw this increase in value once. Okay, so that is a big deal, because if this was to increase in value, then I would be in some deep crap, because my margin buffer would decrease substantially and it would get me closer and closer. All right, so I'm going to explain this, and I'm going to give you guys some pictures or some frameworks that you guys can take and study yourselves. Okay. The most important thing about this whole anchor thing, or this core satellite thing, is that you start off right. Okay. You have to start off with the right one, because a lot of people, and again, I'm not downplaying or shooting a shot at them or anything, or saying, MISTY sucks, but a lot of people were using MISTY as the anchor. And look at this maintenance ratio here. Okay. They completely ignored this. And when we had Liberation Day, and when we had a market downturn and everything was going down, people were getting margin called left and right. And not only that, this was, I think, at like 40% when it was out. And then Robinhood increased it to 70%. So again, very, very important you start off on the right foot. And that is why I really think you should watch that other video if you haven't already done so. Okay, all right, let's get into the actual frameworks here. Okay, so this is the portfolio. This is how it all started. Okay, I started with a portfolio of 100K, and then I used or took out 100K in margin, all right, I'm going to be paying an interest rate of 452. So I got buying power now. I got a lot of dry gunpowder. So I have a 100K deposit with a 100K in margin. That gives me 200K in buying power. I'm expected to pay, with my current interest rate, about $452 a month. So that is, not too bad in my opinion. $452 for 100K. I mean, I would take that deal. So these are my positions as they stand today. Okay. Right now is May 26th. These are obviously, prone to changing in the future, but as of this video, this is what it is. Okay. I have $71,000 in XDTE producing $20,000. I have 66,000 in XPAY producing 14,000, 26 in PLTW, giving me almost 13,000, $27,000 in NVW, giving me almost $12,000, which is really nice. $9.4 thousand, really closer to 9.5 in CHIPPY and from YieldMax. And this is giving me $3.5 thousand in annual income. So all in all, I am making $63,705, but I have a monthly expense ratio or a monthly interest expense of $452. And this will rise or decrease as I, take out more margin or use more margin, or if I decrease my margin, right? So this is always subject to change. But on an annual basis, I'm expected to pay $5,400 in interest. Okay. Now that gives me a net annual income of $58,000, right? Not bad. That is really, really good in my opinion. I mean, is this something you might be interested in, right? I'm not saying go out and copy this exact thing, but I'm just saying, if you only had to pay $452 a month, but you could make $58,000 a year, would you take that deal? I think a lot of people would absolutely take that deal. But again, there's a lot of risks and drawbacks with following this, okay, which we're going to get into in just a moment. So again, just a real summary, just a quick summary, the core, the anchor position, margin maintenance ratio, 25%, portfolio weighting, 40 to 50%. All right. If you guys look back here, XDTE and XPAY, they make up a bulk of this portfolio. Okay. So they make up a bulk of the portfolio. They're following the S&P 500. It is harder for an S&P 500 index to fall 5 or 10% than it is for a single stock cover call ETF to fall 5 or 10%. Okay. If the underlier like Palantir falls 5 or 10%, the cover call ETFs, the 1-2X levered ETFs, they're going to fall just as fast. So you have to be really, really careful with what you choose an anchor as. All right. And then of course, I have the satellite positions. I don't care if their maintenance ratios, fluctuate. I will be able to survive, okay? Because I don't have so much money in these. But that is, essentially just how my portfolio is structured, okay? And they usually have a weighting of between 10 and 20% for the satellite positions. But, I can always change that. I can always adjust as time goes on. So here is the benefits, drawbacks, and the risks associated with following something like this, especially when we're talking about margin, okay? If you're following the core satellite approach, all right, you're going to get some really good benefits. You're going to get a higher concentration to a broad index. That's why I follow this, because I want to lower the risk. I want to lower the probability of a 5 to 10% drop, all right, with the portfolio. I also have lower risk to single stock exposed ETFs. Okay, so this is why I have things like NVW or PLTW. But if you're a YieldMax fanatic, you can look at PLTY or NVDY. There's other ones out there. Pick your poison, whatever you decide. But this is what I follow. All right, by doing this, I lower the risk of what's known, or what I call, portfolio implosion, all right, via margin maintenance increasing in value. Okay, so let's talk about this real fast. If you like, portfolio implosion is what happens when you have a declining market that is going down in value. You have margin maintenance that is increasing in value. Okay, that is obviously really, really scary. So now you're fighting two forces. You're fighting the market and you're fighting the broker. But because of some of these cover call ETFs, they have what's known as NAV erosion. Now you have three forces that you're fighting. Okay. So this is why, and they're all trying to get you down. So this is why you have to be really careful what you choose for your portfolio and how you, use margin. All right. So the drawbacks, and yes, this is a big drawback for some, especially, for people who are high yield or higher yield, they want the higher distribution. When you have an anchor here that is mostly, XDTE, XPAY, those S&P 500 ETFs, yeah, you're going to get a lower distribution. So you're giving that up, but you're getting safety. At least that is my opinion of all of this. All right, that's the way I look at this. I'm more than happy to give up a higher distribution as long as I get more safety. All right, because again, I'm more of a risk averse type of investor. And if I'm using margin, I want to be very careful. If I'm not using any margin, or maybe I'm using half margin or even a quarter margin, then all of this kind of changes, right? You actually lower the risk of implosion when you take out less margin or use less margin. Maybe you're using 25%, maybe you're using 50%, or maybe using 10%, whatever, you decide to do. All right. But here's the biggest risks to all of this. Everything is subject to change. Okay. The brokers can change their minds on a whim, and they can make all ETFs 100%, margin maintenance, whatever, right? It's all subject to change. Has that happened? No. Have I ever seen that happen to S&P 500 or index funds? No. Can it happen? Absolutely. All right. They even say it in their risks when you start using margin that everything is subject to change. So that is just a word to the wise for you guys to understand this. All right. And then, of course, I just want to show you guys, this is the actual margin pays or the actual amounts that I had to pay. I made $3,800 for March. I made $4,500 for April. And then for May, this current month, I'm on track to making between $5,200 and $5,500. So again, not bad, all right? Not bad for the amount of interest that I have to pay and what I'm actually getting in return. All right, guys, so we're pretty much at the end of the video. I just have to give you guys a quick shout out in case you didn't know. I pulled all these numbers from yieldmite.com. If you guys have never used this tool, I really recommend you check it out. Okay, this is coming from Amy at Bad Financial Decisions. She runs a YouTube as well. She covers a lot of high yield investing, so go check her out. Subscribe if you haven't. But this is the tool that she developed, and this is a very useful tool. And basically what this is, they have everything here. They have Global X, they have Granite shares, iShares, Rex shares, Yield Max, Roundhill, Goldman Sachs. They have everybody in here. Okay. Basically what this is if you're to put in like $1,000, it'll spit out, kind of what you'll get annually, monthly, or even weekly. Now these numbers, these estimates are based on their last distribution. All right. So this is not exactly 100% accurate, but it is a pretty useful tool for kind of getting a best guess estimate of what you will get for your money, right? How much income you'll actually be able to make annually if you invest in these ETFs. So just wanted to give her a quick shout out because this tool is actually pretty nifty and it is really cool. So that'll do it for this video. I hope you guys got a lot of value. I hope you learned a lot from this, but this is exactly what I'm doing to produce $60,000 or $63,000 in passive income from these high yield ETFs. And then of course, we take away the annual expenses and it's more closer to 58,000. But you know what? I'm not complaining. So let me know down below in the comments. Did you enjoy this video? Did you like the concepts? Did you like the frameworks? Do you think this is bad, high risk? Would you not do this? Can you give me probably, some opinions? What do you think? Is there some blind spots I'm not thinking about? I just want to know. All right. The more information I have, the better of an investor I can be. So I really like to hear and read people's comments. So with that being said, guys, I will see you in the next video. Take care.